Hi everyone, welcome to today's video. So let me show you a very quick chart, which is a very interesting chart about Japanese Nikkei, which is the index for Japan stock market. And if you check the date that on 4th January 1991, this index was trading at roughly 24,000. Over a span of 30 years, this index has given 3% return. 3%, that's it. So now the obvious question is that, okay, Akshat, why did this happen that Japan gave such poor returns? Number two, can such situation play out now, especially when the world is going through so much trauma, everyone is talking about limited growth, so much negativity is there, so much volatility is there. Super important, super critical video, because if you do not understand things fundamentally, you will just simply go on YouTube, look at random videos. One day people will be telling you bull run is there, you will invest money. Next day market falls by 10%, you will start panicking. So extremely important for you to understand what exactly happened in Japan, and is that situation going to play out now, and will it impact your portfolio? I will give a super simple explanation about this entire complex topic. I had to study a lot, so please give a thumbs up. And also a very quick shout out to our sponsors for today, which is Cuckoo FM. I'm currently listening to a show called as One Up on Wall Street. It's an adaptation of the book by Peter Lynch. If you study such useful material, you will become sharper in your knowledge, and it will become easier for you to navigate the stock market and anything else that you're doing. So consume knowledge selectively, consume knowledge intelligently. So I am putting the link in the description box. Go check out Cuckoo FM. Let's get the video started. First and foremost, let me take you to my Twitter timeline and explain what exactly happened in Japan. Okay, so this is a very important chart that you need to understand very quickly. So you will see that this blue line represents the GDP, right? And if you check this particular range, you will see that in the 80s, the GDP of Japan was going up. It was not as if that Japan was having any specific issue per se. In fact, things were so good that Japan in the 80s was growing at 3.89%, and US on the other hand was only growing at 3.07%. Now these are very good growth rates for developed economies like Japan and the US. So everything was going well, and in fact things were going so well that the Japanese government started fretting a little bit, because they were seeing the bloating of the stock market, the bloating of the housing market. Is that something that you're seeing now? Comment below, let me know. But yes, this was somewhat triggering the government that, you know what, our economy is probably overheating because the prices of all the assets is going up, including the stock market and the housing market. So what did they do next? The central bank, which is the Bank of Japan, it decided to decrease the money supply. Nowadays, you're seeing post 2008, post 2020, the governments or central banks are increasing the money supply. But back in the late 80s, the Bank of Japan decided to decrease the money supply. And what that led to was less liquidity. So there was less availability of the money. And as a result, the valuations of equity and real estate market, it started to come down to sensible levels. There was no problem up until now. But what precisely ended up happening in this particular game was that when Bank of Japan decided to decrease the liquidity in the market, the equities market fell first. So when equities market started to fall, people thought that, you know what, we have to put our money in other asset classes. So they started to move towards the housing market. So the housing market did not fall. In fact, it kept on going up for a little while. And again, the Bank of Japan thought that, you know what, fine, our actions help bring down the equity levels to a sensible level. So let's decrease and withdraw even more liquidity from the market. That will bring the housing market also back to its senses. So they did more of this quantitative tightening, so to say, as we understand today. Now, due to this excessive quantitative tightening, what ended up happening was that the equities market went through a dramatic crash. There was just too much liquidity that was withdrawn at a very brisk pace. The equity market also fell, and the real estate market also started falling. In fact, at one point, things became so bad that as much as 70% of the value of housing market in some areas went away. So from a situation where everything was going great, due to excess liquidity withdrawal from the market, the entire economy of Japan started to face something called as deflation. So I will explain that in a minute. There is a very important term that you need to understand first, because this will help you make sense of the current situation also. This term is called as liquidity trap. Now this is a very important term. Basically what it means is that people or investors are very smart. If they feel that, you know what, tomorrow I am going to get things for cheap, what will they do? They will just sit on cash. They will not do anything. For example, if you are sure that tomorrow the inflation is not going to be there, inflation is going to 100% come down and prices of everything is going to fall, what are you going to do today? You will cut down your consumption as much as possible and you will wait for tomorrow. So that situation in economic terms is called as liquidity trap. It's a situation where people assume that prices of everything will come down. Now, why would they believe it in Japan? Simply because of the fact that the equity equities market crashed all of a sudden. Housing market crashed all of a sudden. So people started expecting that everything will fall and let us just wait and hoard cash. That's it. So that's what people started doing, and that is what led to a situation called as liquidity crunch. Now, under such circumstances, the roadmap is very clear from the government. What they simply do is that they inject liquidity into the market. So they undertake bond operations or they print more money, put it in the economy. People take up that money and they go and spend. So that is the usual roadmap. But how does the government do? So in India, what happens is that RBI, for example, will print more money. Now this money will reach commercial banks like HDFC, ICICI. Now HDFC and all these commercial banks will give loans to people. And when these people get loans, they will go and spend that money in the economy. So this entire chain needs to be completed. But in Japan, there was another situation that played out, and that situation was called as credit crunch. Now, credit crunch simply means that a bank like RBI is printing a lot of money. It is giving it to commercial banks, but commercial banks do not want to lend to the public. Because why? If you have to take a lot of money from your central bank, then you have to open your accounts and show all the losses that you have temporarily undergone. And all the long concealed losses will get uncovered. So this was problem number one, that the commercial banks in Japan, they had to show all their losses, and they had undergone dramatic changes over the last few months due to equity and housing market exposure. Moreover, it's not as if RBI or Bank of Japan can willy-nilly print whatever they like. They are in fact taking external debt also to print this money. So you have to open up your country to foreign investors in a way. So the commercial banks in Japan did not want to do this. They were okay not lending more money to people, and this created a credit crunch problem. So in short, we reached a situation where there was credit crunch, banks were not lending, and people, whatever money they were getting, they were not spending. So this entire situation led to a term called as deflation in the Japanese economy. It simply means that the prices in the Japanese economy did not rise at all for decades. The period 1991 to 2000 is called as the lost decade for Japan because no growth took place. Deflation is a situation where the prices of anything does not rise and low growth happens. Super important term, but I hope that through this very brief thread and very brief conversation, you understood a lot of complex macroeconomic terms. Please press the like button in case you liked it. It will help this video reach out to more people. Now let's talk about part 2, which is that, okay, fine, Japan, this happened. What are the parallels today, and what are some of the key things that are different about the current ongoing crisis vis-a-vis Japan? And are we going to witness a similar situation that Japan is facing? So 20 years, 30 years down the line, are we only going to make 3% Nifty returns? Let's start having that conversation in a few bulleted points. So the first key point that you need to understand is that you need to take a look at this particular chart and look at the inflation. This pink line is the inflation line. So here you can see that towards the late 80s, there was high inflation in the Japanese economy. So currently, point number one is that high inflation is happening in our economies also, the entire world's economy. In fact, it is estimated that in India, going forward, the rate of inflation will be close to 10%. 10%. So which simply means that, hey, go deposit your money in HDFC Bank, get 2% return on it and lose 8% money because the real rate of inflation is 10%. So 100 rupees kept in HDFC Bank becomes 92 by next year. In case you want me to talk about how you can avoid that situation, I'll make a separate video, just comment below. But first point or first similarity between the Japanese 85 to 90 economy and today's economy is that rate of inflation went high. It is going high today also. A related point is that asset bubble is forming. So from the Japanese story, it was very clear that, hey, equities market were going up. Housing market was going up. What is the situation now? Stock markets went up quite a lot. Crypto market went up quite a lot. Housing market, you let me know whether it went up or not. But generally it stayed somewhat similar. But the point is there was a lot of asset inflation that happened in the current world order as well. Now that is not the worrying sign. The worrying sign is that take a look at this particular chart. The current Russia-Ukraine crisis that is undergoing, it is going to create even higher inflation. That is almost guaranteed. Why is that the case? Because from this chart, you can clearly see that Russia is one of the largest oil producers of the world. It has direct correlation to the India's inflation rate in the sense that our 20% import bill, whatever you are importing, 20% of that money goes into importing oil. That is how much India depends on oil. So as the oil prices are skyrocketing, it is leading to sustainable high inflation in a country like India. So that is the inflation issue. A related issue is the supply chain disruption issue. So due to the war, a lot of ships cannot move from point A to point B. A lot of disruption is happening happening. A lot of businesses are not able to produce, extract raw materials, etc., etc. And as a result, businesses in India are getting strained. Now, as per a report, there are 375,000 businesses that rely on Russian supplies. Now, all these businesses are going to face what? They are going to face supply chain disruption that will further escalate the inflation issue. So that inflation problem is very real. I have been talking about on this channel that inflation is going to be super high. I have been saying this for several months now, and now it looks like that we are finally hitting that point when inflation will just skyrocket from this point. So this is the worrying sign that in Japan, inflation was very high. Some kind of supply chain disruption also happened. Same thing, exactly the same thing is happening in the world right now. This brings us to second, but a little positive point, that back in Japan, it was a deflation problem. Deflation means what? That the inflation is not rising. Here, right now in the world, we are facing something called a stagflation problem. So what is this stagflation? So stagflation simply means that it's a combination of slow growth. This was in Japan also, but high inflation. This combination is called as stagflation. Now, let me just break apart this point and do like a very quick commentary here. Why slow growth will happen? Because there are both supply side issues and demand side issues. For example, there are companies that want to produce a lot of stuff, but they are not able to produce it because they are not able to get raw material like semiconductors, etc. to make their finished product. So that leads to supply side issues. Demand side issue means that because of very high inflation, that is the general increase in price rises, people want to buy, but they can't buy because they don't have much money left. A classic case in point is that companies like HUL, Asian Paints, they have increased their product prices by 15 to 20%. So with a 15-20% jack up in prices, you continue, a large section of people would not be able to afford those products, at least in the short term. So what this situation will lead to is slow growth, first and foremost, because companies can't produce and people can't consume because of high inflation. So this is leading to a stagflation problem. In Japan, what problem did we have? We had a deflation problem. Deflation simply means that the prices of everything was just spiraling downwards. Which brings me to a little bit better news, which will hopefully calm your nerves a little bit, that right now there is no credit crunch problem with the banks. Yes, banks are strained, but think about it this way, that when 2020 COVID situation happened all across the globe, the government printed a lot of money, they gave it to commercial banks and commercial banks lended it to a lot of people. How do I know that lending took place? Because the asset prices across the board inflated. That was one of the reasons why after 2020 COVID crisis, prices of everything including stocks started going up. Why? Because commercial banks were willing to lend and they were able to successfully lend. So the roadmap is very clear that in case government starts printing more money or increase more liquidity, which they will, commercial banks are definitely going to lend it out. There is no credit crunch problem that is there currently. So this is a good news for us. Now comes the fourth point. Now here is a brief snippet from Kathy Wood. Please listen to this very brief commentary, then I will give you my inputs.
I wanted to ask you about some of the other markers in the market right now, particularly as it relates to the war in Ukraine. Have we seen peak market impact yet? And what should investors be focusing on here?
It's very hard to say if we've seen peak market impact. I know the markets are getting hit today. Typically, the way we see the peak is through the VIX, the volatility index. And it has moved up. It's in the mid-30s. I'm not sure what this morning is. And the shock in 2018 and the one before that got us into the low 40s. Of course, the coronavirus got us to 80. But we're getting close to those cathartic moments in the past. I would be surprised if we do go to the coronavirus levels, because remember, people were expecting a depression. The whole world shut down. This is not that. This is going to cause a lot of problems from a purchasing power point of view. I think the risk of recession has gone up dramatically as purchasing power is dropping dramatically. In the U.S., the consumer saving rate already is down to levels we have not seen since 2013. So that buffer that the stimulus payments created during the crisis, that's gone. Mm-hmm. And so consumers are probably going to pull back. Sentiment suggests they will, and in some ways they already have. If you average over the last 3 months, this is U.S., consumption in real terms has been pretty flat.
So as Kathy Wood rightly pointed out that we will have slow growth, no doubt about that. We might move to recession, but that does not mean that we are having a liquidity crunch problem. as was the case in Japan. They had money, but they were just not willing to spend it. That is not the situation now. It is much, much more complicated to change the psychology of people. If people just do not want to spend, no matter what the central bank does, it's a bad situation for the economy. And that is precisely what is happening even now in Japan. You just can't change the psychology of people about this. It is very, very complicated to do it. Yes, right now we are having a lot of growth challenges, no doubt about that, but the psychology of people is still to spend money. So whenever the situation improves, we are going to be fine. So you should not get super stressed about the slowing growth. Yes, we will move towards a sideways market, as I have been saying again for several months now. It looks very, very certain that this will be a very elongated sideways market, but fundamentally growth will come back at some stage. The psychology of people has not been messed up with, so to say. Whenever the salaries rise, whenever the employment cycle goes back to full, whenever people have money in hand to spend, they will start spending, and that will revive the economies all across the globe. Now comes the fifth and the most important point, which outlines the difference between the Japanese situation and what is happening currently in the world. And that is the concept of roadmap. So roadmap simply means, and you can understand it through a sports analogy, that when Usain Bolt ran the 100-meter sprint in less than 10 seconds, it was believed that humans just can't do it. It was very, very difficult to run at such a fast pace. It was possibly humanly impossible. But a lot of athletes started doing it. Now we have Usain Bolt, who has broken all the records, and he has run that race in a crazy time. So I hope you get the idea that when someone shows a path, it becomes very easy for humans to follow that path. So Japan has already created a case study by messing up its own economy and has given the world numerous lessons that central bankers, economists now can pick and revive and cultivate their own systems to come out of this mess that the entire world has created. So what is my final advice? And this brings us to the final section, that what is it that you should be doing in case you are an investor? Now I can't give you recommendations, but this is what I'm doing. Number one, I am buying the dips because I truly understand the difference between why the Japan economy crashed vis-a-vis what is happening now. It is short-term pain and we will see a lot of volatility along the way, but I am going to continue to buy the dips. Number two, in this environment, please do not panic buy, or do not panic sell. Why? Because whenever new numbers are released, for example, inflation data is released, the stock market will react very, very violently to it. For example, if the expectation of inflation is 10% in India, and if it comes out to be 12%, stock market will crash like anything. So it's very important to be sensible and understand what is going on macroeconomically. That is the only friend that can help you. Please do not use technical indicators. It will not work in such a market. Third and finally, please invest across asset classes. I have been saying it at the top of my voice for the last 1.5 years. Please be diversified. Please be diversified. Please do not go and invest in one single asset. Please be diversified across asset classes. This includes cryptocurrencies also. So I am purchasing cryptos. I am purchasing equities. I have started to take a little bit of positions even in the bond market now. So I am diversifying and I'm hedging my portfolio. I'll make a separate video on how to hedge your portfolio in easy to understand language. But I hope that this video allowed you to understand and cultivate a fundamental knowledge of what is happening in the stock market, and hopefully it will help you navigate the situation more confidently. Please give it a thumbs up and also check Kuku FM for a special link and a discount, and I will see you the next time.